Friday morning, when global markets open, $14 billion in forced selling will hit gold and silver at the exact same time. This is not fear-mongering, it's not a rumor, and it's not a prediction based on opinions. It's a mechanical event already locked into the system. Algorithms don't care about headlines, emotions, or long-term conviction. They execute. And when they do, prices move fast, violently, and often in ways that make no sense to everyday investors. Right now, most people are focused on where silver has been and where analysts say it could go. Very few are paying attention to what is about to be forced into the market regardless of price. That's why Friday matters. Not because silver is weak, but because structure always beats sentiment in the short term. When the Bloomberg Commodity Index rebalances, funds tracking it are legally required to sell. No discretion, no technical analysis, no waiting for a better price. $7 billion in gold, $7 billion in silver, spread over 5 days of relentless liquidation. If you only understand charts and headlines, this move will feel confusing. If you understand mechanics, it becomes predictable. Welcome. If you've spent years watching markets, you already know that the most dangerous moments are not when everyone is afraid, but when everyone feels informed and confident. Right now, the narrative sounds bullish. Silver recently pushed toward record levels. Analysts are calling pullbacks healthy consolidation. Social media is full of price targets and victory laps. But behind the scenes, institutions are preparing for something very different. Scotiabank has already issued a clear warning. Roughly 17% of silver AS open interest is about to be dumped due to index rebalancing. That's not an opinion, that's math. What most people in T understand is that this selling has nothing to do with silver AS fundamentals or long-term value. It's a paper market event, and paper markets can temporarily detach from physical reality. That disconnect is where mistakes are made, but it's also where opportunity appears. Over the next few minutes, we're going to break down exactly what this forced selling means, why price weakness does not automatically equal a broken bull market, and how to think clearly while others react emotionally. Friday will not respect borders, opinions, or narratives. It will respect structure. And if you understand that difference, this moment could change how you see silver forever. Before the market opens on Friday, most people are still thinking in terms of charts, headlines, and emotions. But the real danger is hidden in plain sight, buried inside index mechanics that don't care about optimism or fear. What's coming is not a reaction, it's a procedure. When large commodity indexes rebalance, they don't trade like humans, they trade like machines. Billions of dollars are allocated and removed according to preset formulas, and once those formulas are triggered, there's no pause button. Silver happens to be standing directly in the path of that flow right now. After weeks of strong performance and headline-grabbing prices, silver's weighting inside the Bloomberg Commodity Index has grown too large. That imbalance must be corrected, and correction in this context means forced selling. Not because silver is weak, not because the bull case failed, but because the rules demand it. This is why markets can fall even when the story looks bullish. It's also why these moves feel sudden and violent. Traders who don't understand this mechanism interpret the drop as panic or manipulation, while professionals see it for what it is, structural liquidation. The danger is that retail investors step in emotionally, believing they are buying the dip, without realizing they are standing in front of a multi-day supply wave that hasn't even finished hitting the market yet. This is the setup phase, the calm explanation before the pressure is released. And if you don't grasp this difference now, the price action on Friday will look irrational, when in reality, it's brutally logical. To understand why this matters so much, you have to separate paper silver from physical silver, because they do not behave the same way under stress. The forced selling that's coming does not involve trucks, vaults, or metal changing hands. It is paper contracts being dumped to satisfy index weightings. That selling pressure hits futures first, pushing the quoted price down fast and hard. But here's where the disconnect forms. Physical demand does not disappear just because an index rebalances. In fact, moments like this often do the opposite. As paper prices fall, physical buyers step in, premiums widen, and real metal quietly vanishes from the market. This is the part most headlines won't explain. You'll see red candles on screens while coin shops tighten supply and delivery times stretch. That divergence is the signal, not the price alone. Scotiabank's warning about 17% of open interest being affected isn't about sentiment, it's about volume. That much paper hitting the market in a short window overwhelms bids temporarily, even in strong bull markets. The mistake people make is assuming the drop means the story is over. Structural selling ends when the rules are satisfied, not when fear peaks. Once the rebalancing is complete, the artificial pressure disappears and the market is left to deal with the real problem it has been avoiding all along. There is not enough physical silver to meet long-term demand at these prices. What looks like collapse on paper can quietly become accumulation in reality, but only for those who understand what they are watching. Now zoom out and look at the timing, because this is where most investors get emotionally trapped. Forced selling events almost always happen when sentiment is already elevated and positioning is crowded. Silver didn't approach this rebalance at $40 or $50. It approached it near record highs, with leverage stacked on top of leverage. That makes the flush feel violent, even if it's mechanical. On Friday, price action may look chaotic. Sharp drops, sudden bounces, confusing headlines, analysts changing their tone by the hour. That noise is the trap. Weak hands sell into it because they believe something is breaking. Strong hands wait because they know exactly why the selling exists and when it ends. This is not a judgment on direction. It's a warning about behavior. If you're watching 5-minute candles, you will feel like the market is collapsing. If you're watching flows and constraints, you will see a reset taking place. Historically, these index-driven liquidations do not end bull markets. They cleanse them. They remove excess leverage, shake out momentum chasers, and transfer exposure from fast money to patient capital. The real danger is not the drop itself. It's misinterpreting a temporary structural event as a fundamental failure. Friday is not about predicting the exact low. It's about understanding that price weakness created by obligation is very different from price weakness created by rejection. One fades quickly, the other does not. The paper market and the physical market finally stop pretending they are the same thing. And while screens flash red and futures contracts are being dumped to satisfy index math, the physical side of silver reacts very differently. Coin shops do not suddenly get flooded with cheap inventory. Refiners do not ramp up output overnight. Mints do not lower premiums just because a fund had to rebalance. In fact, during these forced selling windows, physical premiums often widen, not because demand explodes, but because supply simply doesn't respond to paper price shocks. This is the disconnect most investors never experience until it happens in real time. Paper silver can fall $5 in an afternoon while physical silver barely budges or even becomes harder to source. That divergence is the pressure point in the system. It's also why institutions focus on futures, while long-term holders focus on ounces, not charts. Friday may produce prices that look like an opportunity or prices that look like a breakdown, but neither tells the full story unless you check availability, delivery times, and premiums. This is where patience becomes an advantage. Those who understand the mechanics don't rush, they observe. They let the forced sellers finish their work. They wait for the volume to dry up. And only then do they act, not emotionally, not reactively, but strategically, knowing that when paper selling ends, the market must once again reconcile with physical reality. The forced selling ends because that is where most people get it wrong. Structural liquidation has a beginning and an end. Index rebalancing does not last forever. It is scheduled, mechanical, and finite. Once those 5 days of selling are complete, the artificial pressure disappears, and the market is left to stand on its own fundamentals again. This is the moment when price behavior often surprises people. If physical demand remains steady, if inventories stay tight, and if premiums refuse to collapse, the paper price suddenly loses its downward momentum. Not because sentiment changed, but because the seller is gone. This is why experienced market participants don't panic during forced events. They prepare for the aftermath. Historically, when large index-driven liquidations finish, metals either stabilize quickly or snap back with speed, catching late sellers off guard. That doesn't guarantee an immediate rally, but it does reset the battlefield. The question becomes simple. Did the selling fix a real imbalance, or did it just satisfy a rulebook? If it's the latter, then price weakness is temporary by design. This is where positioning matters more than prediction. Those who sold in fear may struggle to re-enter. Those who chased headlines may already be underwater, but those who understood the structure now hold clarity instead of regret. The market will soon reveal whether Friday was a breakdown or the final clearance before the next leg higher. What happens next will not be decided by headlines, influencers, or 5-minute candles. It will be decided by structure. The forced selling event that everyone fears is not a verdict on silver's future. It is a process the market must pass through. When mechanical liquidation collides with real-world demand, the truth always shows itself afterward, not during the chaos. If paper selling was enough to break the market, then prices will keep sliding even after the rebalancing ends. But if physical demand absorbs the shock, if premiums stay firm, and inventories don't flood back, then this episode will be remembered as a stress test, not a collapse. Most investors lose money because they react emotionally to moves they don't understand. Professionals survive by recognizing when volatility is artificial and when it is fundamental. Friday may feel violent, confusing, even frightening. But clarity comes after the dust settles. The only real mistake now is confusing forced action with genuine market weakness. Stay disciplined, stay patient, and remember this. The loudest moments in markets are rarely the most important ones.
Hello friend, welcome to my YouTube channel. I hope all if you are doing great and having an amazing day. My name is Noor Baqi and I am really excited to start this new journey with all if you. You know, this channel is not just about videos, it is about story and ideas and inspiration. I created this channel to sharing something positive every signal week. Sometimes we all need little motivation, and sometimes we just need a good story to smile again. Decide exactly what this channel is all about. You find understanding stories, real life experience, and powerful lessons that again change the way you think. I be uploading new videos regularly, so if you don't want to miss any of them, make sure to subscribe to my YouTube channel and press this bell icon so you get notification whenever you post something new. You support means everything to me, and to great we can build a community full of partnership, learning, and good vibes. So sit back, relax, and let us begin this amazing journey together. Thank you so much for watching and welcome once again.